Hey traders, Gavin McMaster here from Options Trading IQ, and today we're going to be talking about the 5 most common mistakes when trading the wheel strategy. It's one of my favorite strategies. I've been doing it for nearly 21 years, and chances are if you're not seeing the results that you would like with this strategy, chances are you're making one of these major mistakes. So make sure you stick around to the end because I'll share a quick checklist with you as well that you can use before starting your next wheel trade. So let's get stuck into it. Just a quick reminder that anything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. So let's get stuck into mistake number one. And this is a really common mistake that I see a lot of people making, chasing high volatility, unprofitable stocks. So these could be recent IPOs, meme stocks, hot stocks that are, maybe they're going up and down quite a lot and there's a lot of option premium, but people are getting sucked in with that premium. The big premium is tempting, but often they come from highly volatile and unprofitable companies. So make sure you're checking and make sure the company has positive earnings and it's not all just built on hype. With these stocks, yeah, sure, you can collect more premium up front, but you're also taking on a much higher risk of loss. Focus on profitable companies with stable growth. You'll sleep better and your wheel will spin more smoothly. So for me, I really like blue chip stocks, anything in the Dow Jones, industrial average, Apple, for example, Amazon, Microsoft. Any of these blue chip type stocks are going to be great for the wheel. I also really love doing this on ETFs as well. But let me give you a really good example. And OKLO is a really hot stock at the moment. It's in the nuclear energy space. It's had a pretty good run, no doubt about it. And wheel trades would have done well so far, but it's got negative earnings. You can see here the most recent earnings, negative 18 cents, earnings per share for the last 12 months, negative 42 cents. If we go and look at the NASDAQ, we can see here earnings per share heavily negative. It's all built on potential and hype. So eventually the stock's going to come crashing down. I wouldn't be surprised if at some point we see this drop back down to 40 or 50. You don't want to be selling puts at 100 and starting your wheel trade up here at 100 if it's going to eventually come back down to 40, $30, who knows. You can see here, huge volatility, 111% volatility. The 12-month high for volatility, 171%. So yes, the premiums are there, but the earnings aren't there. So for me, this is an absolute no-no. Now, it might be okay for some people. They might be able to accept that volatility. They might be able to accept the possibility that the stock could drop 60, 70% in a short space of time. But for me, it's an absolute no. All right, mistake number two, using overvalued stocks. Even great companies can hurt you if you overpay. Use valuation tools like Morningstar, Guru Focus to find fair or undervalued stocks. If you've got any other particular tools you like to use as well, that's fine. The wheel works best when you start with a margin of safety. So again, we want to be looking for those blue chip stocks that are trading at a bit of a discount. We don't want to be trading them for a really high PE ratio. Mistake number three, avoiding assignment. So the wheel is designed to get you assigned shares. That's the whole point. We want to be building a position in a stock. We want to be accumulating shares, dollar cost averaging into those positions and holding those shares for the long term. If you're selling puts way out of the money or constantly rolling to avoid assignment, you're missing out on the second half of the strategy. Assignment isn't a failure, it's a path to further income. Remember, once we get assigned, we can sell more puts, we can also sell calls, and we can collect dividends. So some people call the wheel strategy a triple income strategy because we're getting income from selling the puts, we're getting income from selling the calls, and we're getting income from the dividends. If we're constantly avoiding assignment on those puts, we're missing out on the second and third income stream, the dividends and the covered call income. So don't be scared of assignment. If it's a quality company, take assignment, hold it for the long term, wait for it to bounce back, and then sell your covered calls and collect your dividends. Mistake number four, ignoring capital gains. So many traders focus on only the option premium and forget about capital gains. After assignment, consider waiting for the stock to rise before selling calls. You don't have to sell those calls straight away. You can wait for the stock to rally up a little bit. This has been one of my favorite ETFs to trade the wheel. And you can see here it pretty consistently trades between about 19 and 27. We sell puts when it dips. We wait for it to rally back up. Then we start selling calls. We don't necessarily sell calls straight after we get assigned on the puts. We wait for it to rally back up a little bit. So by doing this, you're going to capture both income and capital gains or the upside. Mistake number five, selling calls below the cost basis. If you sell calls below your cost basis, you risk having shares called away at a loss, even if the stock rallies. Be patient, either wait for recovery or exit if the fundamentals change. Don't lock in a loss just to collect a small premium. Now, I know a lot of people do this, and I don't agree with it. I think selling calls below your cost basis is a mistake. Wait for the stock to recover, be patient, sell more puts, continue to dollar cost average in. Eventually, the stock will come back if it's a quality company or an ETF, and then you can start selling your covered calls once you get back above your cost basis. So, mistake number 5, do not sell calls below your cost basis. All right, here's your quick wheel strategy checklist. Number 1, stick with profitable and fairly or undervalued stocks. Have a willingness to be assigned. Have patience before selling the calls. Capture both premiums and capital gains. And avoid panic moves that lock in losses. Thanks for watching. If you found the video helpful, don't forget to like, subscribe, and share your thoughts in the comments below. Reach out anytime with questions, and have a great day.